Hey everyone, let's talk about something that's been catching a lot of attention lately: defense stocks. And if you've been anywhere near the market recently, you've probably noticed two names popping up again and again: Palantir and BigBear.ai. Now, on the surface, a lot of investors treat these two companies like they're basically the same thing. After all, both are tied to artificial intelligence, both work with government contracts, and both are deeply connected to defense. So it's easy to assume they're just two versions of the same idea. But that assumption? It's actually where most people get it wrong. Because once you really break it down, these two companies are playing very different games, and understanding that difference could completely change how you look at the risk, the opportunity, and ultimately, where you might want to put your money. Now, I've talked about both of these companies before, but what keeps happening is that investors continue to group them together without realizing that they're solving different pieces of a much bigger problem. So let's slow this down and really unpack it. At its core, Palantir is focused on one major thing: making sense of massive amounts of data. Think about how much information governments collect every single day. We're talking about satellite feeds, intelligence reports, logistics data, surveillance systems, databases. It's endless. What Palantir does is bring all of that into one place. It builds software platforms that organize this chaos into something usable, something readable, something actionable. So instead of analysts being overwhelmed with disconnected data, they can actually see what's happening in real time. But here's the important part: Palantir doesn't make decisions. It gives humans the tools to make better decisions. The final call still belongs to the person using the system. Now, this is where BigBear.ai starts to separate itself. Because while there is some overlap, Big Bear isn't just organizing data, it's going a step further. Big Bear is focused on what's called decision intelligence. That means it uses AI not just to show information, but to actively help evaluate outcomes. It looks at different scenarios, predicts possible results, analyzes risks, and helps decision makers figure out what they should do next. So instead of just saying, "Here's what's happening," Big Bear is leaning more toward, "Here's what could happen," and "Here's what you might want to do about it." And that difference? It's bigger than it sounds. Because one company is supporting decisions, and the other is trying to influence them. Now, before we get into opinions, let's talk numbers, because this is where things really start to separate. Starting with Palantir, the company has been putting up some serious growth. In its latest quarter, revenue jumped to about $1.4 billion. That's a 70% increase year over year. And this isn't a one-time spike. It's now the third straight quarter where Palantir has crossed the billion-dollar mark. Even more impressive, profit. Net income surged to over $600 million, which is a massive jump compared to the previous year. And when you look at cash flow, it becomes even clearer what's happening here. Palantir isn't just growing, it's doing it efficiently. The company keeps its capital spending relatively low, which allows it to generate strong free cash flow, over $2 billion. That's a huge advantage, because it means Palantir has the flexibility to expand, invest, and scale without constantly worrying about running out of cash. And there's another important shift happening. Palantir isn't just relying on government contracts anymore. Its commercial business, especially in the US, is growing fast. In fact, that segment alone has been expanding at over 100%, and now makes up a significant portion of total revenue. So what you're seeing is a company that's evolving. It's no longer just a defense contractor, it's becoming a broader AI platform. Now let's switch over to BigBear.ai, and this is where the story gets a little more complicated. Big Bear's revenue came in at around $27 million, which is actually down compared to the previous year. That drop is largely tied to reduced activity in certain military programs, so right away you can see the difference in scale. But here's the interesting part: even though revenue declined, the company made major progress on its losses. Last year, Big Bear reported a massive loss, over $100 million. Now, that loss has been cut down dramatically to just under $6 million. That's a big improvement. It suggests that management is starting to get costs under control and move toward a more sustainable model. But when it comes to cash flow, there's still a big gap. Big Bear generates far less free cash compared to Palantir, and that matters, because cash is what allows a company to survive tough periods and invest in future growth. So when you put these two side by side, you start to see two very different pictures. Palantir is operating from a position of strength. It has scale, profitability, strong cash flow, and growing demand from both government and commercial clients. BigBear, on the other hand, is still in the early stages. It's smaller, more dependent on specific contracts, and still working to prove that it can grow consistently. Now let's talk about stock prices, because this is where things get really interesting. Palantir is trading at a much higher price, with a massive market valuation in the hundreds of billions. BigBear, it's sitting at just a few dollars per share, with a market cap under a couple billion. So naturally, a lot of investors look at BigBear and think, this is cheaper, this is the better deal. But price alone doesn't tell the full story, because when you dig into valuation metrics, things become a bit more nuanced. Palantir trades at a very high multiple of its earnings. In simple terms, investors are paying a premium for every dollar the company makes. Yes, it's expensive, but here's the twist. It used to be even more expensive. So while the valuation is still high, it's actually come down compared to previous levels. That said, expectations are extremely high. Investors expect Palantir to keep delivering strong growth, strong profits, and consistent performance. And that creates risk. Because if the company ever misses expectations, even slightly, the stock could react sharply. We've seen that happen before. Now, BigBear doesn't even have a traditional earnings multiples, because it's not profitable yet. So instead, investors look at things like price to sales. And on that basis, BigBear looks much cheaper than Palantir. But again, cheaper doesn't always mean better. Because with BigBear, there's still uncertainty. The company needs to prove that it can scale, that it can win more contracts, and that it can eventually become profitable. So what you're really choosing between here is two different types of opportunities. Palantir is the established player. It's already delivering results, already generating cash, and already expanding into new markets. BigBear is the speculative play. It has potential, it has room to grow, but it also carries more risk. Now, if you look at what analysts are saying, the trend becomes even clearer. There's growing confidence in Palantir's future. Meanwhile, opinions on BigBear are more cautious, with many analysts taking a wait-and-see approach. So where does that leave us? Well, it really comes down to your risk tolerance. If you want stability, consistency, and a company that's already proven itself, Palantir stands out. But if you're willing to take on more risk in exchange for the possibility of higher upside, BigBear might catch your attention. Just understand, it hasn't proven itself yet, and that makes all the difference. Now I want to hear from you. Which side are you on? Are you going with the established giant or taking a chance on the underdog? Let me know what you think, because this is one of those matchups where your perspective really matters. This is not finance advice.